I'd like to thank you guys for celebrating my last day in my 40s with me. I will be 50 tomorrow. So, and I'm glad I can't hear all
Congratulations.
the jokes that are happening right now. Thank you for the birthday wishes. Okay, so we're going to do our normal agenda topics: the market, the Fed, treasuries, alts, the economy, and takeaways. I have slides for each, and let's just jump in. So over the last month, we've seen the market, specifically the S&P 500, up another 2%. That's great. We all have exposure to the stock market. That being said, it's still just perpetuating the overvalued state of the market. And as I've said in previous calls, I do think that the strength of the economy is probably going to reduce how far the market goes down in the future. But I do still think we're going to see the market come down. Okay, treasuries. So we're at our lowest point in 3 months for treasury yields. What that means is treasury prices are at their highest point in 3 months. So we're starting to see the talk of Fed cuts bring those interest rates down. So again, September, we should see a Fed cut this month. And there's a lot of news where they were saying no Fed cuts this year to now people are talking about 3, 4 cuts this year and maybe 6 successive cuts. Perfect example, Bank of America now expects the Fed to cut rates after previously seeing no moves this year. We've been talking about this since the beginning of the year that we're going to see Fed cuts. We have to see Fed cuts. So I'd like to welcome Bank of America to the conversation. Just last month, JP Morgan did the same thing. So good job, guys. Fed is almost certain to cut rates by a quarter point this month. Why are so many people so unhappy about it? That's a great question. So one of the big concerns about cutting rates is that it signals that the economy is not as strong as maybe we hope, that the stock market is out ahead of itself. So historically, and we've talked about this many times, but once the Fed starts cutting rates, it's about 12 to 18 months from that point to when you start to see the market drop. So the Fed actually started cutting last year. So 12 to 18 months is end of this year, early next year. So we could potentially see the market start coming down at that point. So that's why some people are unhappy about it. Other people are unhappy about it because it's potentially a political statement. And so it's become a political battle about the interest rates between Trump and the Fed. And I think they're going to become aligned. A perfect example of that is today, the wholesale inflation number came in negative versus positive 0.3%, which is a huge swing in what was expected. So inflation is actually going down, at least at the wholesale level at this point. So that's good news. You'll see we ticked towards higher chance of more conservative Fed policy, which means cutting rates. So we should see rates start to get cut this month. Okay, as I said, the valuation of stocks is not getting better. It's actually getting worse. So you'll see we're up to 39. That's the second highest point in history. We are likely to see it come down to about the 16 to 20 range at some point. So that's half of where it is now. There's two ways that that comes down to that valuation. One is earnings go up, which I think we will see earnings go up. The other is stocks go down, the prices go down. And I think we will see that as well. So I think we'll see a combination of the two, which makes it where we don't need to see a 50% drop in the stock market to have that happen. So again, I do see earnings accelerating. They're not going to double. We're not going to double earnings over the next year or so. So we will see a combination of the two bring that pillar PE ratio down to normal valuations. The true inflation number, this is as of Monday, was 1.99%. Still below average, still below the reported number by the BLS. So that's well in line with normal or even below the normal inflation rate. So we're doing good there. Gold You'll see gold continues to rise as there's talk of the Fed cutting interest rates. That spiked gold. So we should see gold continue to move. Next is silver. Silver, as we talked about over the last 2 or 3 months, silver was a better place to invest versus gold based on the early run up. So if we look at the overlay of the two, and I apologize if you can't read the gold, but the gold is the dark blue line, the silver is the light blue line. And what you'll see is gold ran up significantly from April until July and got way ahead of silver. Silver actually dropped and was flat for a while. And then since then, silver has caught up and actually exceeded the growth on gold. So they're probably evenly valued as investment opportunities at this point. That being said, silver will always have a better use case. It's used in technical components for a lot of things. So silver actually should have that going for it beyond just the inflationary value of it. So again, we want to keep those two holdings and continue to let them grow. On a side note, GGN, which is one of our funds that we hold, which is the Gold and Natural Resources Fund, it is very high right now. It's up to about $4.90 a share, I believe. Many of you started buying it in the $2.50 to $2.80 a share range. So we're getting up near 100% return on that. Plus it pays a significant dividend. Many of you got in with a dividend around 12%. Currently it's at 7.6% with the rise. So that just continues to grow, continues to compound, continues to pay monthly income. So again, just on a side note, that fund is doing quite well as of late. Okay, so I'm going to touch on these 5 things quickly again. We've heard many, many times about the big bad tariffs and how potentially they're going to cause inflation. Knock on wood, that has not happened as of yet. In fact, inflation is much lower since the tariffs started than it was at the beginning of the year. Tax cuts, we've seen those start to affect how companies and individuals invest. Almost everybody, if not everybody on this call, should have a positive benefit from the tax cuts and the big beautiful bill. So your situation should be better this year than it was last year. Deregulation. We're starting to see deregulation lower the cost of certain things like energy. Energy being the biggest driver of the economy. Everything gets shipped, or all the AI and crypto use energy. So all of these things are important to be able to clear the path for those new technologies. A reduction of wasteful spending. We've seen huge amounts of government jobs get cut. We've seen spending on what many would consider how do I want to put it? Things that are not helpful to the US or the US economy getting cut. So those funds can go towards things that do help the economy and do help US citizens. And then finally, that last piece is starting to tick into place. It looks like this month will be the month where the Fed starts cutting again, and we should see interest rates come down. So all of those things, as they work together, will strengthen the economy, will increase earnings. They won't hedge the market against a loss. We see losses there, but the way we're invested, as interest rates go down, long-term treasuries go up. So we should do quite well through the end of the year. In fact, the average all-weather account is up between 8.5% and 12.5% year to date. So we're on pace for a very good year. So very pleased with that. That being said, any questions, anything, and certainly I'll wait for Tracy to type them in for me.
Yeah, reminder in case you weren't here at the beginning, Matt cannot hear you, but I can. So